Big questions, of course, still about the strength of the consumer. It's a big week, as you know, for retail earnings. And on that note, let's bring in top-ranked retail analyst Matthew Boss, JPMorgan, joining us once again. You don't cover Target specifically, Matt, but what does it tell you, if anything, about where the consumer is today and how retailers are dealing with all of the issues that they've had?
I think as a whole, the retail picture right now is stable. Now, that's tied to the unemployment level sub 4%. Wages continue to rise for the low end, and the high-end consumer is sitting on a tremendous amount of wealth creation over the last 5 years. Now, to me, the picture beneath is more mixed. I think the high end is solid. The low-end consumer is on stable territory. It's the middle where we're seeing a lot more volatility. That middle-income consumer, I think, is tied to some of the layoffs that you're seeing larger picture.
Have companies worked through the significant inventory issues that they've had, and how does that impact your view on where margins could go in the months ahead?
So I think you're in the second half of the game from an inventory perspective. The trough was in the summer and in the fall. The inventory actions that you're seeing take place in the third and the fourth quarter, that's why you're seeing the bottoming in the margin picture. I would say by late spring, we're going to be in the 7th to 8th inning, and I think coming out of that, heading into the summer this year, you're going to start lapping up against some material margin deterioration. You're going to have freight moving in the right direction, gas prices and some of the inflationary pressures easing. And remember, it was in the late spring into summer. That's when the consumer started to rebudget a year ago and really make up for some of these costs of living that were rising materially.
We've got Dollar Tree reporting that's in your universe. Stocks having a good day in a down market, up 1.5%. I'm looking squarely at it. What are your expectations for something you have rated out overweight?
Yeah, so we like Dollar Tree, we like Dollar General, we like the off-pricers, TJX, Ross Stores, and Burlington. That to me is the key, value and convenience. Low income is stable, middle income value is becoming more important. That's where you're seeing the trade down. So I like that, and I like best-in-class brands on the other side, particularly casual. Nike, Lulu, I think that's the mega trend coming out of this.
Yeah, Mike, the real question as to whether the consumer is really as strong as it appears to be.
Yeah, I know there's a lot of concern about the ramping of, credit card borrowing recently and the idea that the savings rate has gone down. But if you ask me, the bigger unique aspect of this environment is that you had a huge run in credit card debt and it just went back to trend. And the fact that the savings rate is down because people already have the savings cushion. So I wouldn't doubt that there's fraying around the edges.
Delinquencies picking up a little bit.
Absolutely, right? But from such depressed levels. I mean, anything you look at, I look at the household financial obligations ratio, which bundles in all kinds of debt service payments, and it's just not at a level where historically it's paid to get super worried about it. So you'd have to see wages soften up a lot. You'd have to see actual job losses. But maybe we're also in this weird moment where the whole pull forward of goods demand and the fact that we don't need as much stuff is also clouding the picture as hotel stocks go to the moon every day.